Right now, roughly 12 million American homeowners are writing a check every single month, not to pay down their house, not to build equity, but to protect their lender's investment. It's called private mortgage insurance. And the mortgage industry has spent decades making sure you believe it's just part of the deal. It's not. PMI is one of the most profitable line items on a servicer's balance sheet. And there are 5 legal ways to kill it, years before they'll ever volunteer that information. One of these methods saved a buyer in Denver over $41,000, and it's probably available to you right now. Here's what your mortgage broker didn't explain at closing. When you put down less than 20% on a conventional loan, you're required to carry private mortgage insurance. The pitch sounds reasonable. It protects the lender if you default. But here's what makes PMI a profit machine. You pay the premium, the lender gets the coverage. You are buying an insurance policy that protects someone else's money. In 2024, private mortgage insurers collected over $6.8 billion in premiums from American homeowners. The default rate on those same conventional loans, under 2%. That is a staggering profit margin, and every month you're the one funding it. The Homeowners Protection Act of 1998 was supposed to fix this. It created mandatory rules for PMI removal. But the way these rules were structured actually favors the lender. Here's the critical distinction almost nobody understands. There are 2 thresholds, 80% loan-to-value and 78% loan-to-value. At 78%, your servicer is legally required to automatically cancel your PMI. But at 80%, 2 full percentage points earlier, you have the right to request cancellation. If you ask, that 2% gap might sound small. On a $400,000 home, it represents roughly 18 months of extra PMI payments. Your servicer will never send you a reminder that the 80% option exists. That silence alone can cost you over $3,400. Loophole number 1 is the simplest and the most overlooked. The moment your loan balance hits 80% of your home's original purchase price, you have the legal right to request PMI cancellation. In writing, let's put real numbers on it. Sarah bought a home in Austin for $550,000 with 3% down. Her loan balance, $533,500. Her PMI rate, 0.85% annually. That's $378 vanishing from her bank account every single month. At 80% LTV, her balance needs to reach $440,000. By requesting removal at 80% instead of waiting for automatic cancellation at 78%, Sarah saves roughly 22 months of payments. That's $8,316 just from writing a letter. Your lender will likely require a current appraisal and proof of clean payment history. Budget $300 to $400 for that appraisal. The return on investment, about 20 to 1. But here's the thing, the next 4 loopholes can save you even more. This is the one that changes everything, especially in appreciating markets or for anyone willing to do strategic upgrades. PMI is calculated on your loan-to-value ratio. Most people assume the value is permanently locked to the original purchase price. It's not. Not if you can trigger a new appraisal. Meet David. He bought a 3-bedroom in Charlotte for $425,000. Put 5% down, so his loan started at $403,750. His PMI, $283 per month. 2 years in, David spends $32,000 finishing his basement and upgrading the kitchen. He requests a new appraisal. The home comes back at $510,000. His remaining balance of $391,000 now represents just 76.7% of the new appraised value, well under 80%. PMI eliminated. Time saved, approximately 9 years of payments. Dollar savings, over $30,000 minus a $400 appraisal fee, and the renovation itself. It added $85,000 in value on a $32,000 investment. He killed his PMI and built equity at the same time. One critical note, not every renovation moves the needle. Kitchens, bathrooms, and finished basements deliver the highest appraisal bumps. A swimming pool. Almost never worth it for this purpose. Here's a strategy almost no one talks about: swapping borrower-paid PMI for lender-paid PMI through a strategic refinance. With lender-paid PMI, the insurance cost gets baked into your interest rate, usually 1/4 to 3/8% higher. Sounds worse on paper, right? Here's the twist. Lender-paid PMI has no separate monthly charge to remove. It simply doesn't appear as a line item. And it's tax-deductible as mortgage interest, which borrower-paid PMI often is not, depending on your income bracket. Take Marcus. He carries a $400,000 loan at 6.75% with $220 per month in PMI. He refinances into a new loan at 7% with lender-paid PMI. His rate ticks up slightly, but his total monthly payment drops by $140 because there's no separate PMI charge. Over 5 years, that's $8,400 in savings, and he picks up the tax deduction. This loophole works best when interest rates have dropped since your original loan, or when you're tantalizingly close to 80% LTV but can't quite cross the line yet. When you request PMI removal, your servicer orders a property valuation. Sometimes it's a full appraisal, but increasingly, servicers default to something cheaper, a broker price opinion or BPO. A BPO is a less rigorous assessment. A real estate agent drives by your property, pulls a few comparable sales, and sends in a number. And here's where most homeowners make a critical mistake. They accept a low BPO as the final answer. It's not. Under the Homeowners Protection Act, if you disagree with a BPO, you have the right to challenge it and request a formal appraisal, a full interior inspection by a licensed appraiser. Lisa in Portland learned this the hard way. Her BPO came back at $460,000. She knew her neighborhood was outperforming the comps the agent used. She challenged it, paid $450 for a full appraisal, and the result came back at $512,000. That $52,000 difference pushed her below 80% LTV and eliminated $197 a month in PMI. Annual savings, $2,364. A BPO uses limited data. A full appraisal captures your upgrades, your finishes, your specific neighborhood trajectory. If a BPO comes back low, challenge it, every single time. The final method is the most aggressive, and probably the one your financial advisor hasn't mentioned. A piggyback restructure means taking out a home equity loan or HELOC to pay down your primary mortgage balance below the 80% threshold, then requesting PMI cancellation on the primary loan. Jennifer and Michael bought in Raleigh for $480,000. Primary loan balance sits at $432,000. PMI, $312 a month. Current home value based on recent comparable sales, $520,000. They take out a $40,000 HELOC at 8.5%. They use it to pay their primary balance down to $392,000, exactly 75.4% of the home's current value. PMI removed immediately. Yes, they're paying interest on the HELOC, about $283 per month, but that's $29 less than their PMI was. And here's the real difference. Unlike PMI, every dollar they pay toward the HELOC builds equity. PMI builds nothing. Over 7 years, their net savings after HELOC interest, $14,600, plus they own a larger share of their home. This strategy requires discipline. You need to actually pay down the HELOC. But for homeowners with strong cash flow, it's a powerful move. Let's bring it all together with one number that should make you angry. Remember Sarah from Austin, $550,000 home, 3% down, 0.85% PMI, $378 every single month. If Sarah does nothing, just makes her minimum payments and waits for automatic cancellation at 78% LTV on a 30-year mortgage, she will carry PMI for approximately 13 years. Total PMI paid, $58,968, nearly $60,000 to protect her lender. But if Sarah combines Loophole 2, the renovation reappraisal, with Loophole 1, the 80% request letter, she eliminates PMI by year 4. Total PMI paid through year 4, $18,144. The difference, $40,824. Add back the $400 she saved by not needing a second appraisal down the road, and you're looking at $41,000. That's a full kitchen renovation, 2 years of in-state college tuition. A real number, from one line item on your mortgage statement that most homeowners simply accept and never question. Before you take action, avoid these 3 costly mistakes. Mistake 1, assuming your servicer will notify you. They are legally required to cancel at 78%, but they are not required to remind you about the 80% option. That reminder never comes. Mistake 2, missing payments. Most PMI removal requests require a clean payment history, no 30-day lates in the past 12 months, no 60-day lates in the past 24 months. One missed payment can delay your PMI removal by up to 2 years. Mistake 3, ignoring your amortization schedule. Every mortgage has one. Pull yours up tonight. Find the exact month your balance drops below 80% of your original purchase price. Put that date in your calendar right now. Set a reminder. That is your PMI kill date, and no one is going to hand it to you. Here is your 5-step action plan. Step 1. Pull your most recent mortgage statement. Find your current loan balance. Step 2. Calculate 80% of your original purchase price and separately 80% of your estimated current home value. Use both numbers. Step 3. Check the gap. If you're within $10,000 of the threshold, explore accelerated payments or the Piggyback HELOC strategy. If your home has appreciated significantly, go straight to requesting a new appraisal. Step 4. Send a formal written PMI cancellation request to your loan servicer. Certified mail. Return receipt requested. Do not call, do not email. Paper creates a legal trail. Step 5. If denied, exercise your right to challenge the valuation. Request a full appraisal under the Homeowners Protection Act. Do not accept a low BPO as final. Your money, your equity. Your move. Every month you carry PMI you don't need. You're writing a check that protects someone else's investment, not yours. The 5 loopholes we just broke down are legal, documented, and available to most conventional loan holders right now. If this saved you money or opened your eyes to what your servicer isn't telling you, send it to someone who's still overpaying. And if you want more strategies the mortgage industry doesn't advertise, subscribe. We publish them every week.